Now I'm going to show you how to trade like George Soros, how to trade like Ray Dalio, and all this comes when you have read 100 books and you have economics in your middle finger, little finger, doesn't matter, whatever. So Maras, can you open investing.com and open bonds on it? Bond market. I will lead you. You know, go markets, bonds, and world government bonds. Yeah, here. Now find Turkey.
Just
down, Turkey.
So this session has been recording or what?
Yes, this is recording.
Okay, sir.
Okay, so who can tell me what is a government bond? Do you know what is a government bond?
yeah, you can explain in short term.
Okay, I'll explain.
I mean, you are the only one who read 100 books, so it's probably better that you explain than I do.
Okay, so US dollar against Turkish lira, this is their currency. You see that
you can put a weekly time frame.
Sure. You can see, I actually suggested Maras to go long. I will tell you, it's around here.
Yes.
When I told Maras go long. So what is now my idea behind the trade? Now let's number one. Okay, let's start the same story again. Number one, macroeconomic data. Okay, what does macroeconomic data tells me? Turkey. Now, what do we look at? Do you remember from the beginning? What are the three characteristics we look at? GDP, right? We look at inflation. We look at unemployment. White, right? Understand? So, looking at the GDP, Turkey, you can look it at the other web page. There are a lot of pages that can be used to understand the macroeconomics. One of them is trading economics. Then you see that GDP is strong in Turkey. Strong and growing, okay? Gross domestic product is GDP. Do you guys know what is GDP? GDP is the value of all goods and services produced in a country in a specific period of time. Okay, so if let's say I'm Germany, my country is Germany. If I produce in 1 year only 10 cars and each car is worth, let's say, $10, my GDP is $100 per year. Okay, is it clear? If I produce, let's say, I don't know, I'm in Sri Lanka and I produce 50 bananas per year and one banana is $1, my GDP is $50. Whatever I produce in a country, its price times what the amount of that I produce is actually GDP. Okay, so if one country produces 2 cars, which is each $10 each, for the sake of the easy argument, let's say $10, and produces 1 banana, GDP is 2 cars and 1 banana, meaning $20 plus 1 banana, $21. So GDP is everything that is produced from cars, from services, from doctors, also come into GDP. GDP is also, in GDP you also have, I don't know what else is produced in the country, bricks, furniture, whatever is produced in the country is GDP. So you look at the GDP. So Turkey has strong GDP. Turkey usually imports oil. For example, this is one of the important factors, but doesn't matter now. Then you look at, what did we say? Inflation. And what do you have? Turkey has, if you look at open the news on Turkey, they have hyperinflation. They have very, very high inflation because they are very bad at monetary policy. And this is where we have a chance to make a lot of money, because the idiots are actually running the Turkey country. And when idiots are running the country, you know what hedge fund says? They say thank you. And they take the money from
I don't, just a second. I don't think that we should put that video on YouTube. I think Erdogan will find you.
Yeah, I don't think we should. And then we have unemployment. Turkey has got, let's say, good unemployment. Good because, yeah, it's a long story. I will not go that much into detail. So now that we know what is the macroeconomic data behind our story, what that tells us about Turkey. Then what we look at, how can we use it to make money? Okay. Then what we look at, when we see that hyperinflation, we see that monetary policy. We look at that. What is their monetary policy? As we said, guys, if you want to fight inflation, you increase interest rates. And if you study the history, what Erdogan did, what they did, they had high inflation. And what they did was they reduced interest rates. So having said that, now you know why I shorted Turkish lira up down where I suggested, Maras. The idiots reduced interest rates when you have to fight inflation. You see, they reduced interest rates when you have to fight inflation. So now, when you also know that, you know that you had to short actually Turkish lira. That was a great opportunity. And now let's construct the picture more. What we think now is we look at the current situation, meaning market sentiment. Okay, the current situation, market sentiment says, I think in fifth month, elections will take place. If we have fifth month and election takes place, even if this is my hypothesis, so I will write it like this: hypothesis. Even if Erdogan wins or if he loses, if Erdogan wins or loses, he will have to fight inflation. Why is it that important? If you look at the news, you will see that they had a lot of the problems, a lot of street protesters and a lot of government protests because of the high inflation, because the people who are poor are getting even more poorer, because their bread is no longer $1, but $3, and they're actually losing money. So if you're a professor in high school in Turkey, you actually live very poor life. And they don't like it. These are people that have finished their college degrees, they're intellectuals, and they are very poor, which is very, very bad for the Turkish economy. So what my hypothesis is, if Erdogan wins or loses the election, he will have to fight inflation. If he has to fight inflation, what does that mean? Central bank will have to raise interest rates. So this is another thing that I expect what will happen. When central banks raise interest rates, bonds will fall. So usually bonds are, think about bonds, if bonds are a debt instrument, bonds are a form of credit. So when country wants money, they usually issue bonds or go to another bank and tell them, I need a loan. If they issue bond, for example, they can issue it over several years. So I will give you an example. Let's say I am Turkey government and I issue a bond that is worth $1,000 over 2-year period. What does that mean? And you buy it from me, and I'm a Turkish government. You buy it from me, and I tell you, listen, Maras, for example, I will give to you back this $1,000 after 2 years, but after every year, after first year and after second year, I will give you 5% on this $1,000. That means at the end, you will actually make $1,010 from buying my bond. So you loaned me $1,000 and I give you $1,010 after 2 years. First year, I give you $5. Second year, I give you $5 plus $1,000. This is what bonds are. So now that you know what bonds are, just remember this, when country raises interest rates, bonds usually fall, bond markets fall. And now that we know that, we go to, where is the investing.com?
Up.
So now that we know that, we look at the 2-year government bond and we see yield is a percentage. If you bought 2-year government bond, now you would get 12% interest rate per year. For example, if you bought $1,000, you would get 12% is $120. You would get $120 after first year, $120 plus $1,000 after second year. And now that we have set our hypothesis that Turkey will fight inflation after Erdogan probably again wins the elections, central banks will have to raise interest rate, which will actually mean that these yields will go up and bond prices will go down. Think about it this way. We are actually making a bet that Turkey will raise, its central bank will raise interest rates, and that these yields will go up. If these yields go up, then we make money, okay? So you see how we have constructed the whole picture, macroeconomic fundamental picture, what is most likely to happen. Let's say I'm 90% sure that this will happen, and then we go on and short the bond market, and that's how we make money.
Okay, one question.
Yeah.
So according to your knowledge, you believe that we will have a good short opportunity on this pair?
No, on this pair, I wouldn't touch this pair. You know why? Because if you're looking at US dollar against the Turkish lira, you would have to analyze the US economy. This would be a long opportunity on Turkish lira against the dollar, because Turkish lira is getting stronger. But what if the central bank?
Yeah, but that means according US Turkish lira, then that means that the price will fall.
Yes.
Turkish lira gets stronger. Yeah.
Yes, but it is more riskier trade than shorting bonds, because if you look at the bonds, you only look at the Turkey. If you look at the US dollar against the Turkish lira, you need to also look at what the American economy is doing. Likewise, we were talking about the GJ pair. We were looking at the British economy and we were looking at the Japanese economy. But with the bond markets, you look at the macroeconomics of the whole world, let's say, plus the Turkish economy, and that's how you construct your picture of what is most likely to happen. And this is how you make a lot of money. But you also need to be ready to lose money, okay? Depending on how much you want to lose. But these are not, then you say, I'll take some kind of a technical analysis and find my trade. But these are trades that give you the most opportunities to make really, really big money.